Good afternoon and welcome to our FBF online seminar. My name is Pierre Schlosser. I'm the scientific coordinator of the Florence School of Banking and Finance, and it's a real pleasure for me to welcome you all to today's online seminar on liquidity stress testing for investment funds. I'm very glad to welcome our lead speaker of today, Christian Winkler from the European Securities Market Authority, where Christian is responsible for ESMA's work on identification and assessment of risks to investors, markets, and financial stability in the EU in the area of securities markets. Prior to joining ESMA in September 2013, Christian has worked in managing roles at the UK FSA and FCA and in the Capital Markets Department of Man AG. He holds a doctoral degree in economics and a CFA charter holder. It is a CFA charter holder. So today's discussion focus is a very topical one because stress tests are usually known for being instruments assessing the financial soundness of banks and ultimately their capital adequacy. Today we'll have a different intention and scope. We'll look at liquidity stress tests and we'll apply them not to banks but to investment funds. And to guide us through this new world, we're really lucky and appreciative of Christian's presence, who is based in Paris. I don't know how strikes are doing in Paris. You will tell us. Many thanks for being with us today, Christian. Also, many thanks to my colleague Jan, who has supported us in the preparation of the seminar and is managing our online platform as we speak. Now, before entering the very intriguing discussion of today, I would like to inform you about our school's upcoming activities in just a few minutes, two if I manage. Today is our last online seminar of the year, but we'll host two online seminars in January, one on low interest rates and one on anti-money laundering. The European Universities Institute's Florence School of Banking and Finance, us, FBF in short, holds indeed a diversity of policy debate and training activities, and our online seminars are only one of the many activities that we have. So a key line of activity at our school, and that's why we're called a school, is our residential training courses, and you will see on the slide who typically attends them, and you will also notice that since the school's creation, we've trained more than 2,500 participants from more than 75 countries. You can find more details on all our activities on our website, but what I wanted to do was flag three of them, three courses upcoming. One coming up in February with Professor Rocher and Parigi, which will look at models for financial stability. Then in March, we will have a course on liquidity regulation, to which Christian will participate. By the way, we'll have a session on liquidity risks and stress testing. And then in April, last year, we'll host a residential course with Nobu Kiyotaki from Princeton University on liquidity crises. But there will be many other courses happening next year here in Florence. So I won't go further in that. I'd like just to introduce you to one another. Looking at the laptop, I can see that you are 73 connected today, following us from several countries in Europe and the world. We're very glad to count on several participants from the public and the private sector. We have a variety of organizations like we usually do. And this time, 57% of you are trained economists, 14% are lawyers, and 12% have a background in business. And lastly, in terms of PhDs, we have 21% of you who have a PhD, 70% who have a master's degree, and 9% who have a bachelor degree. So this is just for you to understand a bit who's in the virtual room today. And let me now just say a few words about how this online seminar will be structured. Essentially, we'll give the floor to Christian in Paris, who will tell us in about 20-25 minutes about liquidity stress testing for funds. And after that, we'll immediately go into a Q&A with you joining in, making sure that you can comment and that you can address questions to Christian. We'll regroup them most probably, but also feel free to use the chat box to provide your comments directly in the box. Christian, so I would just invite you to connect your mic and camera and to share them with the platform. So these are two operations. I see that you're connecting, and I see you now. So I leave the floor to you. Let's just do a quick mic check.
Thank you very much, Pierre.
Hear some noise.
Can you hear me? Can you hear me?
Okay.
Okay.
Yeah. So I will disappear and come back then for the Q&A. Yes, I hear you perfectly.
Thank you very much, Pierre, for the kind introduction. And it's really a pleasure, like, to give this online seminar from Paris, where kind of strikes are a bit of a hassle at the moment, but cycling is always an option. So why do we talk about this topic today, about investment fund stress testing? So the issue here is, so I want to explain kind of this issue with you, like, in three parts. First, I give you a bit of an introduction why it is important. Then I briefly touch upon basically the breadth of ESMA's activities in this area. And thirdly, I take you through a case study of a fund stress simulation we have carried out, and specifically focusing on bond funds. So, firstly, why do we care about liquidity stress testing in investment funds? So, key issue really here is, can funds meet mass redemption requests? Basically, when investors want to get out of the funds rapidly, and many of them at the same time. This is important both from investor protection perspective, but also from a financial stability perspective. And why is that? So I'll give you a bit of the market backdrop and also the political backdrop for this. So from the market side, we are now in the low for long interest rate environment, and there are incentives also for search for yield, and that might be also give incentives for funds to move into less liquid assets. Secondly, we had recent events where funds had difficulties meeting redemption requests and had to resort to kind of barring investors from redeeming their assets. These have been idiosyncratic, isolated events so far, with kind of very different reasons in these cases. And a third bit, why from a market side, kind of this is important. The size of the asset management industry has grown very rapidly since the financial crisis. And we are standing now at kind of assets under management of around 15 trillion euros in Europe. And in first instance, this is something good, because on the political backdrop side, if you look at the goal of the European Commission and the Capital Markets Union, the goal is to bring investors, especially also retail investors, into capital markets. And the fund industry plays an important role in this. But also from that perspective, kind of sound risk management practices are really important to achieve this. And they are important, again, from an investor protection perspective and from a financial stability perspective. On the political side, it's also important to know that kind of securities regulators at national level, at European level, ESMA, and also at IOSCO level, at the worldwide level, are looking to the issue. But also importantly, the European Systemic Risk Board has had an expert group in investment funds a while ago, and has issued recommendations how to address any potential issues from that. And I see that Francesco Jordan is also on the seminar. And again, then on top of that, the central banking world is also looking very closely into the matter. And there, especially the Financial Stability Board has issued recommendations to address risks from the asset management sector. And in this space, they have issued two recommendations which are relevant here. One is that on a fund level, kind of securities regulators should provide guidance to funds how to carry out stress tests. And on a market-wide level, on an aggregated level, regulators should give consideration to system-wide stress tests. And ESMA has, in fact, worked on both of these areas. So I very quickly take you through in what we have called a three-pillar approach, where we, as ESMA, have published work for three different work streams over the summer. And the first one, and I will focus in the presentation later on the second work stream on our stress test simulation, But what we've done as well is we have first also addressed supervisory conversions issues. This is addressing the FSB recommendation 6, and so we have been providing guidance to fund managers how to carry out stress tests, and providing clarity on the requirement in the UCITS directive and in the Alternative Investment Fund directive to funds how to carry out stress tests and to authorities how to supervise it. So this is really about promotion of good industry practice and effective risk management, and can help achieving supervisory convergence across the European Union on entity-level stress testing practices. Turning to the right-hand side of the slide, on there we have requirements in the money market fund regulation, where ESMA has to provide on an annual basis kind of stress testing guidelines with very concrete parameters for money market funds to carry out stress testing. And also these results will then be reported back to the national securities regulators and to ESMA. And now this is a bit more like kind of a classic stress test exercise in the sense that basically there are scenarios and kind of the funds are given kind of very specific instructions how to carry out the stress test, and these results are reported back. And this is two perspectives. Again, it's on a micro level. It's guidance for funds how to do kind of stress testing. But also, this is something where once we start to receive results, which really like starting end of next year, we have then kind of an overview in terms of kind of vulnerabilities in the money market fund space. Now, let me then turn to kind of the focus of this presentation, to our fund stress simulation. And here we really want to address to see whether there are kind of pockets of vulnerabilities in the fund industry, and whether this can have any systemic repercussions, kind of can have spillovers into the markets, into the wider financial system. And what we have done there is we have developed a framework to carry this out, a framework to carry out stress simulations, and have also published an economic report where you will also see the link how you can access this later in the presentation. Now, just a quick recap. So what is important to understand is that in the investment fund space, what you want to achieve with stress test exercises is in fact quite different. So they serve different purposes. And this is important to understand before we go into our specific case study. First of all, on the investment fund level, kind of funds carry out or should carry out stress testing of their portfolio as a regular part of their risk management. And UCITS and AIFMD provide guidance on how to do that. So second, sectoral stress test. This is what you know from the banking world, from the insurance world. So it's market level coordinated stress test based on a dedicated reporting data. So regulators ask for specific data from the funds, from the entities. This is what we can do with our money market fund stress testing. The third bit is what we call our sectoral stress simulation. This is really a desk-based exercise, also based on commercial data at the moment, where we at a market level simulate stress scenario. And this is what we call our ESMA stress simulation and the economic report we have published in September. So what are the objectives of our fund stress simulation, which we gave a nice acronym, STRESSY? First of all, it's about assessing the resilience of the European fund industry. So it's really about identifying potential vulnerabilities or pockets of vulnerabilities in the fund industry. Second, we want to see whether the fund industry has the ability to amplify shocks to the financial system. So we're trying to measure spillovers from the fund industry. And also important to know that this publication we've made is not a one-off exercise. This is really about we're going to incorporate that in our ongoing ESMA risk monitoring framework. So that's in the future, at least twice a year, we will publish results of fund simulation exercises in our trends, risk, and vulnerabilities reports, which some of you may know. And importantly, the results from our stress simulation exercises are obviously also important for supervisors. So the results and the methods are available for the national securities regulator also to prioritize entity level supervision. Now, I will now take you through our case study, which we have carried out to look at the EU bond fund industry. And we'll do that in several steps. First, I tell you like what a sample looks like and how we have calibrated our stress simulation. The second step is that I show you the results at a fund level where kind of vulnerabilities lie. The third step is that I show you kind of what would be the market impact, the potential spillover into markets with first round effects. And the last step is that I give you also indications whether there are any second round effects, kind of longer term market impacts from a shock to the fund. So, what is our scope? So we are looking at UCITS bond funds and mixed funds. So, and here the question, and we're covering like with our commercial data around 2.5 billion of assets under management, which is around 90% of the bond fund universe, which is in fact like really pretty comprehensive. And why are we looking at this? So the rationale is a potential liquidity mismatch. Most of these funds are providing daily liquidity to the investors. So basically, if you want to sell your fund share, then basically you can do that on a day-to-day basis, and the fund has to give you the money the day after. On the other hand, when you look at bonds, it might be a bit difficult for funds to sell kind of their assets in that short period of time, especially in the less liquid parts of the bond market. So, and in that case, like if many investors want to basically get out of a fund at the same time, funds might have issues to basically meet those redemption requests. And this is what we're looking at, kind of where in the bond fund industry could this happen. So for that, in the first instance, you need to calibrate kind of the size of your mass redemptions, and also look at kind of what kind of how you assess the liquidity of the fund assets. Now, in terms of redemption shock, we have looked at historic scenarios and came out with a severe but plausible loss of around 10% of the net asset value within 1 week. So, so which means like the fund would need to liquidate around 10% of its assets within 1 week. And looking at kind of, for example, that this is something realistic and maybe not even that severe, is when you look at what happened to H2O earlier this year, we were talking about kind of redemptions of around like 30% in a week. Now, at the liquidity of the assets, you can look at this in different ways. Ideally, you look at this kind of on a really asset-by-asset basis, on a bond-by-bond basis, and look at the time it takes to liquidate that. But this is a really difficult exercise. So what we resorted to was, in fact, banking regulation. Here in the banking regulation, you have kind of the high-quality liquid asset approach, which assigns kind of liquidity weights to kind of different type of assets. And we use this and classified the assets of the bond funds according to this approach. And what we observe is that kind of the liquidity of the assets varies across fund styles. This is nothing surprising. So what you see like on the bottom right is that basically kind of high yield funds have a very low proportion of liquid assets, whereas like kind of emerging market funds that looks a bit better. Where when you look at kind of plain vanilla bond funds which invest in euro or global fixed income instruments, kind of they do have quite a significant proportion of liquid assets. Now, what are our results on the fund level? So what we find is that overall, kind of high yield funds are the most vulnerable funds. And we have looked at this under two different assumptions. So you can, in a way, like the kind of the redemption shocks we've applied, we have applied them first by kind of overall by fund strategies, so high yield strategies, emerging market fund strategies, government bond strategies, and so on. But we have also, that was our what is here at step one. But we have also applied this basically on a fund by fund basis. So really, what is kind of their historical shocks, the most severe shocks they had, and we see that the results are quite different. When basically we look at kind of the same shock size by fund strategy, where kind of shock sizes are tendency a bit lower, we see that most funds are resilient apart from high yield funds. And overall, when you look at kind of when they are not resilient, i.e. when they don't have enough liquidity to meet the redemption request, then the shortfall is limited. That looks a bit different when you're working with a heterogeneity assumption. So the shock is calibrated on a fund by fund basis. Then the size of the shock can be higher. And again, like what we find is that most funds are resilient except for high yield funds. But when liquidity shortfall appears, it is larger, and there are a few funds which have rather significant liquidity shortfalls, more than 10% of their net asset value. And they would really run into trouble. So overall, what we find is that for high yield funds, we would see that around 40% of them would have a liquidity shortfall, whereas for other fund categories, this is much, much smaller. Where you are in emerging market bond funds, where there's also less liquid assets, you're talking about kind of 2% of net asset value, 3% of funds, and even less so for kind of more standard bond funds. So overall, like kind of the bond fund industry seems to be resilient to kind of large redemption shocks, with the exception of high yield bond funds. We also see that some of them would really have on the bottom right side would really have very large kind of liquidity shortfalls up to 30 to 40%. Now, looking at what type of impact this kind of mass redemptions and then the selling activity of the funds could have on markets and prices on markets, on bond markets, we look at this in two different ways, because an important assumption to make here is what approach do funds take on how to sell kind of the bonds into the market. Now, there are two. We have taken two extreme approaches, and just it's important to know that we have done this from an analytical perspective. This is not that we as regulator see kind of they have to do it this way or the other way. There are requirements on how funds have to do this, but the results we have found are really like we see from an analytical perspective to provide a lower bound and an upper bound perspective of the results. So first, we have looked at so the two approaches are what we call a slicing approach and a waterfall approach. And the slicing approach means that assets are sold in proportion to their share in the portfolio. So, i.e., the fund manager doesn't look at kind of how liquid these assets are. So if the fund manager has like 50% of liquid assets and 50% of less liquid assets, he would sell that in the same proportion. Whereas when we look at the waterfall approach, the managers would sell the most liquid assets first. So would first go for cash, and then for the most liquid assets, which would then be mostly probably government bonds and the liquid elements of the corporate bond sector. Now, what we find is when we look at the slicing approach, so the assets are sold in proportion to the share in the portfolio, that the market would still be able to absorb this additional selling into the market, apart from high yield bonds. So the selling pressure arising from this kind of fire sales is generally above average trading volumes in the market. But still, we would have some price impact, which would be below 50 basis points for kind of government bonds, corporate bonds, with the exception of high yield and emerging market debt, where we have impacts of more than 150 basis points, which would be quite significant. Now, when we look at kind of what happens with the waterfall approach, that's basically the asset managers sell the liquid assets first. We have much lower selling pressure, and kind of the markets essentially all markets are able to absorb kind of sales into the market, and you have also much less price impact. So it's less of 50 basis points across asset classes. So what happens in the market really depends on how asset managers sell kind of their assets. Now, we have also looked at wider markets, because obviously, like if kind of funds start to sell assets into the market, there is kind of selling pressure into the market. This could have knock-on effects, and other investors also want to sell. So we're looking at kind of what would be the second round impact on markets and prices. So second round impacts would further reduce kind of net asset value and would further lead to kind of losses for investors. But kind of these second round effects are much smaller than the first round effects. And what if the size of second round effect really very much also depends on the selling strategy of the fund managers. If they resort to a waterfall approach, the second round effects are close to zero. And if they resort to kind of a slicing approach, then we have second round effects. But they are also most pronounced by 2.7% for high yield funds, 1.6% for emerging market funds. You see that on the top right of the slide, and much less pronounced for kind of pure fixed income, global fixed income, mixed funds. So to sum up and also to give time for discussion, so what are the key takeaways? And also what is kind of the way forward? What do we intend to do with this fund stress simulation model? So on the fund side, on the individual fund side, we see that most EU bond and mixed funds are largely resilient to severe redemption shocks. This means that the funds have enough liquid assets to meet redemptions. But we do see those pockets of vulnerabilities in the fund industry, especially when the funds are exposed to less liquid assets. That's true then for high yield bonds, high yield bond funds, and emerging market funds. On the market side, we see that selling pressure from the funds can generate sizable market impact, but as I have explained, kind of the liquidation strategy of the fund managers largely determines the size of that market impact. And this is when we use the waterfall approach, there's not much happening in terms of kind of market impact. But when the slicing approach is used, which fund managers probably might be using, then you see that you have an impact of around 50 to 150 basis points in most markets. And for high yield bonds, the cumulative impact can really add up to 400 basis points. So that would be quite significant. Now, to close, so we have done this case study on bond funds, but this is with this fund stress simulation model, we have created a toolbox. So we can look at other issues in the fund industry as well. So we could apply this to specific shocks. So we could use this model as a basis for dedicated analysis of these shocks. And examples for this could be, at the moment, there's a lot of talk about kind of that in the bond universe, especially in the corporate bond universe, but also in the government bond universe, we have kind of a concentration of BBB rated bonds, so bonds which are just investment grade, and what would happen if kind of these bonds were downgraded, and then kind of funds would start to sell these bonds into the market. So we could look at a scenario like this. Same, like we could look at CLOs and kind of the impact of this. But we could also look at kind of real estate funds and what would happen like to real estate funds should there be a real estate price collapse. We could even also said like we have a severe scenario, but we could be opting for simulating even more extreme scenarios across markets or also assets. And we could also go more into kind of a stress testing space and look at a system-wide impact simulation on the basis of a market scenario. And now I'm very happy to take your questions.
Thanks a lot, Christian. I think it was extremely insightful and rich. So I think people will take a bit of time to digest also the empirical material that you brought in. We'll have now a Q&A session where every one of you should feel free to type their questions and comments in the chat box, and then I will make sure that we moderate the questions and give some time for Christian, who is alone, to be guided through them and have a bit of time to answer them. Before we do that, and to give you a bit of time to put your thoughts together and write them down, I think I had two questions to you, Christian. The first would be a sort of taking a bit of a distance from what you the all the various parts which you've covered today. What did the exercises allow you to see that you didn't see before? So what did it reveal to you that you didn't anticipate to see with the stress testing exercises? So that would be one. And then I wanted to invite you also to go a bit deeper into the data dimension. You were mentioning that you relied for some of the scenarios, at least on commercial data. Would there be any scope also to use reporting data which are confidential going forward? And in that sense, also, what would be the workload necessary to make sure that you have good data? I think this is a broader discussion that we could also have if you wish to. But I see that there are several questions, so feel free to maybe pick up one of the two I just gave you, and then we will go into the questions of our dear participants.
Okay, thank you very much, Pierre. So I take those two questions in turn because they are really important ones. So what did we not see before? What did we see? What we did not see before? In fact, like at bond funds, for the bond fund universe, kind of what we saw in terms of result was what we kind of expected. Now, and this was quite reassuring. So we were hoping that kind of plain vanilla bond funds would be resilient to these types of shocks, and what we saw that they mostly were. So that was good and reassuring. And on the high yield funds, this was also well, not unexpected that these would be funds kind of that could run into trouble, like whether it be mass redemptions. But this is also something which is important to monitor because in the context of kind of a low for long interest rate environment, there will be incentives also like to move more into space, kind of to find some yield in markets. So this is something to watch out for. Now, on the data dimension, I think very good point. So we have been using commercial data because we are looking at UCITS funds. And for UCITS, there is no kind of regulatory reporting to kind of regulatory reporting to securities regulators. So we were kind of bound by using commercial data. When you're looking into the alternative investment fund space, there is regulatory reporting. They could at least in parts use that reporting, but only in parts. Because what you need for liquidity stress testing is full portfolio data. And that is also something the AFD reporting in the current current format does not provide us with. We have only top 5 positions. So in the near future, kind of for UCITS and for alternative investment funds, we will we'll have to rely on commercial data. Basically, for alternative investment funds, we can enrich that with regulatory data. Different question for money market funds. Where in the future we will have kind of regulatory reporting which can be used also for kind of stress testing for stress exercises. And one point which I just saw in which I can address up front already because I saw the question is we have also applied kind of the usual assumptions for stress when you do stress testing. We have not incorporated any reactions by fund managers. So as well in the banking stress test, basically kind of there is no reactions of banks to kind of stress results are not incorporated. So here we have also not done this. So we have not taken into account kind of the tools funds have available to manage kind of these redemption requests. And so, for example, swing pricing or kind of blocking redemption for a number of times, which is in fact what has happened, like in kind of for Woodford, for H2O, and also kind of for real estate fund in the UK very recently. But this is kind of standard practice in stress testing exercises.
Okay, thanks a lot, Christian. So I see there is a question from Francesco. Buongiorno, and thank you for the congratulations from the ESRB Secretariat. So Francesco is asking, do you think the impact of slice strategy is worrisome? Is it more or less than you expected, and what should authorities do?
Okay. First of all, thank you very much, Francesco, for the kind words. So I think in the first instance, we really have to see kind of the slicing strategy and the waterfall strategy as an upper and lower bound of the results. Now, what we have seen here is it worrisome or not? I'm not too sure, because if we are looking at kind of the standard parts of the fund industry, the market impacts are still okay-ish. So this is something, kind of the price impacts could be they're still okay. We really see kind of the big impacts are in the high yield, really on the high yield side, and this is overall still a relatively small part of the market. So what I would say here is that this would be mostly an investor protection issue, because really kind of investors in these funds would lose. But I don't see that. I'm not convinced that we have a financial stability issue at the moment here, because that part of the fund segment is probably too small to really have a large spillover effect into the system. But it's something worth looking at. Now, and also the point, I think it's also then important to see that in practice, kind of funds could mitigate kind of these impacts by applying their liquidity management tools. So basically like kind of gating, doing swing pricing, just to manage kind of outflows, but also manage to give them the time to sell assets into the market which would then kind of reduce the price impact if you are able to kind of spread out the sales from within a week to a couple of months at the limit. So this is something important. So what is important is maybe also what authorities could do is sometimes, to me, and that is my personal opinion, that's not an ESMA opinion, is kind of in these kind of stressed market situations, kind of it could also be that kind of using kind of this liquidity management tools would be a stigma for a fund. Whereas in a way, like you would use them to protect the investors in the fund so that they lose less money. And there it is important also for investors to know that that basically, like it's not it's a very good investment tool, but once you move into kind of less liquid assets, then there's also some risk with that, which comes with the higher returns. And that risk might also mean that in market stress, it might take you a little more time to get out of a fund.
Okay, thanks a lot. So I'm looking at the screen here, seeing that there are questions of different types. Let's maybe try to go systematically through them. I think we've covered 2 already. So there is a question by Stephanie who asks, could you please specify the methodology used for the shock calibration?
Yes. First of all, I think there it's important, like, so I was given kind of a really broad overview of how and only a case study of what we have done. But we have published a report, and I think the EUI colleagues have kind of put up the link to that, where basically we have explained kind of the toolbox for all steps of our fund stress simulation, and set out kind of what different approaches there are available and which ones we have chosen. And here for the shock calibration, we have really looked at kind of historical shocks and have calibrated these.
Okay, thanks a lot. A question by David on the timeline. So on the foreseen timeline, you have in mind to implement the exercise across the UI asset management space, which seems very ambitious to me, but you're going to tell us.
First of all, one thing which is important to know is, I think what does not make sense for investment fund stress testing, and this is also where investment fund stress testing is quite different to kind of banking or insurance stress testing, is to apply a one-size-fits-all approach. Because if you're looking at asset management, kind of different parts of the asset management industry are very different and the risks attached to it. Like an equity fund is very different to a bond fund, is very different to a hedge fund, is very different to a money market fund. And even like within kind of the bond fund universe, kind of as I've shown, the risks are very different. So basically, like this kind of one size fits all approach is probably not something we have in mind, because I don't think this would give us meaningful results. So for us, what we're going to do is we are going to start kind of tackling different parts of issues in the risks in the fund industry, with different parts of fund industry over time. So this was not a one-off exercise. So we will do that on a regular basis. We provide at least updates like twice a year in our ESMA trends, risk, and vulnerabilities report. Where we have either kind of a specific case study, for example, what I've said, like kind of what would happen, like if there was a mass downgrade of BBB rated bonds, what would the impact there be on the fund industry? Or we move into the equity space, or we move into the alternative investment fund space. But this is kind of then work in progress, and we will do that like at least twice a year.
Okay, thanks. So a question on the simulation model inputs and outputs. Someone's asking, can you tell us a bit more about the model itself, or point us in the right direction for seeing more detail on the model structure, etc.?
I think overall this is something where I would need like quite a lot of time, like to explain the model in detail. So I've taken you through different steps, and what I think is important is kind of the link to the report where we explain our model in detail. And I will also explain the model in much more detail in the seminar Pierre has alluded to in March in Florence. But I think this is like very difficult to do, like in 5 minutes of time.
Yep, sure. So I think Bogdan's question on liquidity management tools available in fund in the future, including swing pricing, I think you addressed that partly, or would you like to say more?
No, I think that's what I had to say. We haven't included them. And this is in line, in a way, like with kind of how you deal with stress testing exercises. Which in fact also means is that basically that kind of the results you find in such a simulation are also some upper bound exercises, because kind of tools fund managers have available are kind of mitigating the impact. For example, when you look at what happened with H2O, when they were in introducing their liquidity management tools, that really appeared to help kind of slow down the outflows of that fund. So at least that might have been one of the contributing factors. This is important to know, that there are tools available for funds kind of to deal with kind of stress situations.
Yeah. Okay. A question from Marcus, who says, thank you for this insightful presentation, and then makes a link also to banks, as you will see. Did ESMA find any measurable impact onto banks induced through funds liquidity stress? Is it something you took into consideration?
And the answer is no. We haven't looked at this. So we're really looking at kind of the funds themselves and the impact on the overall markets. So what we did not look into kind of the connections to the banking sector or the insurance sector or the pension fund sector. They would be also be.
Okay. Then there are two questions from Dorota. Let me just check how many questions we have more. Okay, let me pick one question from Dorota. So maybe for you to choose. So there is a question on, do you see the point in stress testing other funds also, other than MMF, bond, and mixed funds? And then the first question would have been about average daily trading volume. So I think a more specific one. You choose.
I can take both of them. So, but let me start with kind of the point in stress testing other funds also. I think that's what I've already answered. I think this is yes, definitely so. And this is something where you can really kind of look at specific risks in funds, and kind of these risk pockets may also change, like with kind of different markets situations. Say like if at some point, hopefully, we might also move out of the low interest rate environment. Whenever that happens, then kind of risks in markets might be quite different, and you might want to focus on different type of funds. So on the average trading the average daily trading volume. So we were not looking at the asset management industry as such. We were looking really at the average trading volume of the underlying bonds in the market, and we're seeing, like, with the additional selling pressure from kind of funds, would that be able to be absorbed by markets? That's what we did.
Okay. Thanks a lot. So a very precise and specific question from Nicola saying, asking in the LST final guidelines document, many guidelines are prefixed by the term should, and it's a different emphasis than possibly using the verb must.
Okay. Now this is a policy question, and kind of, and as a disclaimer, I'm not in the policy department of ESMA, but I'm in the risk analysis and economics department. But I think I think it's important to understand what guidelines mean. So first of all, guidelines are what we call level 3 regulation. So level 1 and level 2 would be European directives, regulations, and kind of ESMA technical standards. And what guidelines do is, in fact, like giving more precision and more guidance on how to apply, and be more specific on how to apply kind of the level 1 and level 2 regulation. And in that sense, quite often, there's not only one way to do this, but several ways. And this is where quite often kind of this verb should instead of the verb must comes.
Okay. Thanks a lot. Then we have a few more questions and then we will close. There is a question. So thanks, Jan, for sharing the report. You all can see it now. Other asset classes in the funds, e.g. equity funds, I think we covered that partly, unless you want to engage. And then we have voice check. Can the fund managers use a waterfall approach if it doesn't comply with the fund internal limits of the limits given by the law requirements? Given by the law.
First, yeah, on Cosmina's question, yes. So that's what we're going to do. I can't give the exact timelines of what we are going to do when. On Wojtek's question, so this is a tricky one. So in principle, I think a pure waterfall approach is probably not possible for fund managers, because what you then have is you kind of you might disadvantage kind of the existing the fund investors which remain in the fund, because they will be left with the less liquid assets and the most impacted assets. And that is also why there are kind of these legal kind of limits on what kind of fund managers can do, kind of in terms of kind of slicing. So kind of standard approach would be slicing, and then kind of how far they can deviate is, as you have seen, as you have said yourself in your question, like given in the limits of the law. Now, why have we kind of shown a pure waterfall approach? This was really for analytical purposes, because this kind of showing a pure waterfall approach and a pure slicing approach gives you really kind of the extreme scenarios and an upper and lower bound of the impact. That we have shown the waterfall approach doesn't mean that this is a reality how fund managers work in practice.
Okay. I think we managed to cover all questions at this stage. So I see that more questions are coming in. Is there anything that you thought you wanted still to address which hasn't been covered either by your presentation or the questions? So complementary from your side?
No, from my side, I think I've covered everything I wanted to cover. Just also encouragement, if you're interested in basically in more details, to look up the report on our website. Because I think it's really not sales marketing or advertising, but I think it's really quite a good and interesting report.
Sure.
And also sets out in quite detail like how you can approach kind of a fund stress simulation, and that you have many choices, and this also justifies the choices we have made in our approach. And I also wanted to thank kind of all kind of the participants, because it's really quite a large crowd which was there for listening to me, and also for the nice comments. Just seeing there. Thank you very much.
Thank you. Yeah, we got a lot of thank you remarks, so we thank in return. Perhaps a very last question, which I usually formulate. I'm not sure you will be able to answer it now, but maybe in a future occasion. Is liquidity stress testing something that makes Europe stand out, or is it a global practice? I mean, how are things in the US or in Asia on this? If you know, of course.
I think liquidity stress testing is something which has really come for funds, is really something which has come to the fore over the last couple of years. And what is important to understand here is I think kind of regulators across the world are really working on this, also securities regulators. And there's also some very detailed work at the moment going on at IOSCO level. So I think we are not the only ones working on this, and this is also because it is such an important topic. And it's also important to know that this is really important from an investor protection perspective, because if funds if isolated funds are not managing their kind of liquidity properly, then you have an issue for investors in that particular fund. And we have seen that this year in a couple of cases. But it's also important, given the size of the fund management industry, and then the potential wider market impacts it may now have, to have kind of these tools in place, like to mitigate any potential kind of financial stability risk which may arise from large redemptions in the fund industry. If you have kind of a really kind of a market-wide shock rather than idiosyncratic fund-specific shocks.
Okay. Thank you very much. I can see more typing, but I guess it's more to say thank you and goodbye. And
I see that someone has spotted my German accent. But Dankeschön.
Yes. Very good. No, thank you. Thanks a lot, really, Christian, for all those helpful, background briefing, analytical exercises which you've put together at ESMA. I just wanted to close and say that if you're more interested in learning more about liquidity risk, liquidity regulation, and to some extent stress testing for banks and for funds. So we mentioned our course coming up in March, also with you, Christian. I think we're very keen at the school to have this ongoing policy debate, mostly because it's in our DNA. We're an intergovernmental organization, the UI, which is also a university. It's sort of a hybrid nature. And this is why it's really very appreciated to have around the table institutions, academics, private sector discussing, and we can see that the online instrument helps to create that community. So without further ado, I'd like to thank you all a very good afternoon and invite you also to check out our website from time to time. Thank you.
Thank you also from my side.